As to where we are in this bubble, I think we're on the verge of it beginning to collapse. I mean, I think it's topping out. What will make it collapse is the next rise in bond yields. At the moment, having had a bit of a rise, they're consolidating, they've come back a little bit. They will go higher again. And as they go higher, the whole of the credit, the gigantic credit system, will come under threat. And the first thing we'll see is that there will be a massive bear market in equities. Lots and lots of money will be lost. I think we'll also see cryptocurrencies come down as well, because crypto are correlating very nicely with the Magnificent Seven tech stocks.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian. Some of you know me as Triangle Investor from social medias. I'm joined today by Alasdair Macleod, a very known name when it comes to precious metals and someone whose interviews I always enjoy listening. So today I have the opportunity to ask those questions. Alasdair, thank you for coming today. It is great to have you.
That's my pleasure, Lucian.
Thanks. Like I said, I watched a lot of your interviews, and I see that one of the most important messages you address to the audience is that we are facing a big credit bubble. Can you clarify to me why do you think that, and are we already in the early days of the bubble bursting?
Yeah, the bubble is really quite simple. You never have an even increase in the amount of credit in the economy. And, when things look sort of better, banks tend to increase their balance sheet leverage by creating loans, which creates credit in the economy. There comes a point where that gets a little dangerous, and then banks think, well, we've got too much risk on our balance sheet. And the two ways in which they can compensate for that, basically, are to lend money to the government rather than the private sector, and also to increase the rate, the interest rate, which they request private sector actors to pay. And that leads to, if you like, a turnaround in the economy. So, you have an economy which, is expanding, and then suddenly it starts contracting, as it were. Contracting in the sense that because credit is redirected towards government borrowing, you find that the private sector ends up in trouble. Now, this is a cycle of bubbles which has been going on since the 1980s, and particularly none of the bubbles have been allowed to wash out the malinvestments, the zombie companies, the companies which shouldn't survive because they don't actually produce what consumers want profitably. So those are the companies that should get wiped out every time the bubble bursts, as it were. But the bubbles haven't been allowed to burst. Each bubble has fed into the successive one. So each bubble has got bigger and bigger and bigger. And we saw a very big bubble accumulate by the time 2008, 2009, sorry, which manifested itself in a property crisis. That bubble was never allowed to burst. I mean, the Fed sat there with its checkbook and said, right, open check. Anyone who needs money, we'll give it to them. And it was followed by crises in Europe. You had Cyprus, you had Greece, you had, all these things started going horribly wrong. And again, the ECB said, whatever it takes. That was Mr. Draghi's mantra. So what we now have is we have the accumulation of all these bubbles into one big bubble. And the symptoms of it are really quite clear. I mean, you look at the valuation of equities on Wall Street. They're chasing the Magnificent Seven, the big tech stocks, on a momentum basis, not on a value basis. I mean, if value came into it, you'd be selling Tesla, for example, because Donald Trump's turned around and said, I don't go for this climate change rubbish. We're withdrawing from the Paris Agreement. Furthermore, we're going to hit China with tariffs. Where are Tesla made? A lot of them are made in China. That market there is diminishing. That's a stock that should be sold under any normal value judgment. But instead, it's at an all-time high. I think it will be sold. Of course it will. But so you can see that's an evidence of a bubble. There's a bubble, if you like, in the equities. And certainly, given that bond yields have already risen, this means that the valuation basis for the equity market is now more stretched than it was in the dot-com bubble back in 2000. I mean, that's quite something when you think that the behavior of people in that dot-com bubble was absolutely extreme. So that's one aspect. Another aspect is the cryptocurrency phenomenon. I mean, Bitcoin. They're going up forever. What are you buying? You're buying some digits. I mean, we had you could buy these sort of I can't remember what they were called, but it was sort of electronic art. It wasn't even that. I can't remember what they called them, but people were paying silly money for nothing, and that's a sign of excess credit. And this is why you have inflation in the system. I mean, by inflation, what we mean actually is a decline in the purchasing power of currency, and that's going to continue. So as to where we are in this bubble, I think we're on the verge of it beginning to collapse. I mean, I think it's topping out. What will make it collapse is the next rise in bond yields. At the moment, having had a bit of a rise, they're consolidating. They've come back a little bit. They will go higher again. And as they go higher, the whole of the credit, the gigantic credit system will come under threat. And the first thing we'll see is that there will be a massive bear market in equities. Lots and lots of money will be lost. I think we'll also see cryptocurrencies come down as well, because crypto are correlating very nicely with the Magnificent Seven tech stocks. It's quite clear that the people who've been gambling in Bitcoin are the same people who gamble in those stocks. It's like a tech stock, if you like. So I think we're going to see that. That's going to be the first sign of it. But rising interest rates, rising bond yields are basically going to undo government finances big time, because governments, and particularly the United States, with a debt to, with a debt to GDP of around about 125, 130%. And the economy is not being productive. This is the other thing, Lucian. The Congressional Budget Office came out with figures earlier this month, is estimates for GDP and for the deficit. What we're looking at, I mean, realistically, the deficit is going to be about 8% of GDP. They reckon that GDP will grow by 4.5%. Virtually all the deficit is spent into GDP. So what we're seeing is, if you take the government spending out of GDP, the private sector is actually contracting in America. So this is actually, you do the same sum with most of the other G7 nations, and you'll find that France in particular, bad news. Britain, bad news. Italy, bad news. I mean, this is everywhere where you've got these deficits, these nations are going into debt traps, and the biggest debt trap of all is the dollar debt trap, and it's that's going to unwind the entire credit bubble.
Yeah, I couldn't agree more on the multi-bubble environment, and a lot of red flags and dangers are ahead. But you mentioned crypto. We are facing the value destruction, in my opinion, where some virtual meme coins worth more than the market cap of some crucial commodities. I mean, the carnival casino era of cryptocurrencies shows that we are in a pure gamble economy.
Yeah, yeah.
How do you see that? And the main question is, why are the commodities still undervalued? Everybody says that should be a lot higher, but nobody is asking the question, why are they undervalued?
Well, commodities have started to rise. and it's really where the flows of credit go. That's the key to it. So, I mean, the credit has been going into, financial instruments. It's been going into equities. It's been going into government bonds, all that sort of stuff, and not into commodities. So, but that is now changing. And I think this last year we saw commodities rise roughly 18% or a figure like that, somewhere between 15 and 20%. Um, Gold, of course, rose by more than that, about 24, 25%. So, yeah, we're seeing things turn around, and a lot of that is not so much demand for commodities, but the declining purchasing power of currencies, which are credit. I mean, the top level of credit is a currency. So I would expect to see commodity values measured in these currencies increasing over next year.
Yeah, can we add to the list of bubble dangers? Okay, we have crypto, we have stock market, we have credit. Can we join real estate on the list as well?
Yes, you can. I mean, particularly, well, both commercial and real estate will be undervalued, will be undermined by rising mortgage costs, rising finance costs, if you like. They're being seen very much as an extremely profitable investment over long periods of time. And I think that there's still that sentiment that, if you've got bricks and mortar, as they put it in English, you're safe with bricks and mortar. In other words, it's tangible, it's real, it's not some airy-fairy funny share or whatever. So, you've got that sentiment. But the problem is that the pricing of property does depend on the availability of finance and the cost of that finance. And if the cost of the finance rises, then obviously that's going to impact negatively on property prices. So I think that is also something that's going to happen. So that's going to be no safe haven, I'm afraid.
Yeah, when it comes to the stock market, what do you foresee? Do you see music slowing down in the first half of 2025, or do you see the music stops, like Jeremy Irons said in the movie Margin Call?
I think, well, I don't know. It's going to slow down very rapidly, that's for sure. And I think I wouldn't rule out a crash because as soon as people begin to realize that interest rates are going to go up, I mean, at the moment, apparently, one further cut is in the Fed funds rate is expected in the market later on this year. I mean, that's changed from two in this year. They're now expecting one in the third quarter, apparently. That's going to go. That's not going to happen. And when people realize this, and I think probably when you see the 10-year US Treasury yield more than 5%, everybody's going to alarm bells. And I think that's going to start collapsing the equity market. And I think the collapse actually could be very, very quick because everybody is in there. They're in there up to their necks, and more leveraged as well. And of course, the other thing is that all this stuff is the collateral for the banking system. And the Fed is going to be in a quandary because under those circumstances, it would want to cut interest rates. I mean, every time a bubble has sort of started rolling over, the Fed has cut, 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 cut. But this time it can't. It's not going to succeed. I mean, if it cuts interest rates, the initial consequence may not be fully understood by people, but the effect on the purchasing power of the currency will be anticipated by gold. That is for sure. Gold will, measured in any currency terms, go far higher. But actually, what's happening is it's not gold going up, it's currencies going down. And then you will see that, the inflation problem is just getting worse and worse and worse. There will be a shift, I think, out of industrial and tech stocks into mining stocks. And that again, I think, is likely to sort of, if you like, create problems. The move of capital out of equity markets into commodities, if you like, and commodity producers. I think is going to exacerbate the problem. But that's, investment managers are going to realize that under these circumstances, that is the place to be, not in equities. So you could see the switch happening really quite quickly.
Yeah, that's a good point on gold. Gold actually rallied more than 1% and hit 2 month high yesterday after the remarks on tariffs. How do you see gold performing in the short term? I mean, okay, let's see short term and mid term. Do you see central bank buying likely to remain the key to gold's 2025 performance?
Yeah, I think the first thing to understand, and this is a point that actually the central banks understand, is that it's not going up. It's not gold going up. Its currency is going down. So that's the first thing and it's a very, very important distinction. The Bank of China, for example, you think it's buying gold. No, the emphasis is that it's selling dollars and it's selling euros. And other central banks are doing the same thing. I mean, they're not necessarily saying that the whole thing is going to fall apart. What they're saying is that there is now a greater risk in paper currencies, so we need to adjust our reserves accordingly. And so that's what they've been doing. There is also a geopolitical element in it because they can see that Russia and China have accumulated large quantities of gold. If you're a member of the Shanghai Cooperation Organization or an affiliate or an associate, dialogue partner, I think is the term as well, then, in various meetings, you will have discussed gold with, your opposite numbers. And I know pretty well, what the discussion is likely to be. It's likely to be, that the West, the dollar is toast over time. Anyway, we need to move away from the dollar because we don't want the American interference. So, that actually could be rather nasty for the dollar. So we need to have gold to protect our own currencies. So, the whole thing is there. And also, if you go back to the St. Petersburg International Financial Conference back in 22, this was after the West had stolen Russian reserves to the tune of over $300 million. Putin said quite clear, this is what these guys do to you. So don't have your eggs in the Western basket. Be as independent as you can. And furthermore, if you've got any gold stored in, with Western central banks in the Western Alliance, you would be wise to get it out. So you can see that there is a far greater understanding of the role of gold in this current situation than there is, let us say, in Western financial markets. They're beginning to learn. And I mean, I'm looking at gold as we're talking. Today's what, the 22nd of January?
Yeah, yeah.
Gold price is 2757. That's literally within what, 30 odd dollars of the all-time high, which was back in last early November. So, it looks like it's got enough momentum to go higher. But I mean, actually, what's happening is that it's going lower. The dollar's going lower. Now, the reason the dollar's going lower is we've got a new president who's a spendthrift, and he's going to introduce tariffs against China and against the European Union in particular. And the effect of that is that the consumer is going to have to pay higher prices. The consumer price index rises. What can the Fed do? Not a lot. It can't cut interest rates. And then you've got the budget deficit, which I think will be somewhere, it could be 2.5 trillion. And that's just inflation. That's debasement of the currency being injected into GDP. So, yeah, and non-Americans, foreigners holding dollars are watching this. And this is the assessment they're making. They can see that interest rates are going to have to rise. They can see that the US economy, while it appears on the surface to be growing, in fact, it's not productive. If anything, it's an inflationary form of growth. And the US is in a debt trap. And, Trump, I mean, he's not very much liked in Europe, except by, if you like, the people who are sort of anti-socialist. Who are gathering, incidentally. I'm not saying that, what he's doing is all bad by any means, but on economics, I'm afraid that he's going to drive up the rate of inflation, which, put another way, is the purchasing power of the dollar going down. And who's going to want to buy the dollar? Who's going to want to fund government debt? I mean, at this rate, what, 5%? Well, it's 4.75% or something on the 10-year US Treasury. No, I don't think so. 5%? No, maybe not. You could be looking at what, 6, 7%? And when it gets there, what happens to the arithmetic about the US government debt? Oh my God, it's getting worse and worse and worse. No, we just get out, don't get involved. And if anything, if we got dollars, get out and go and buy some real money with it, which is
Yeah,
gold.
yeah,
Yeah.
yeah, agreed. What about silver? What will be the trigger for higher silver prices?
Well, I think it's more the commodity story that you brought up just a moment ago. I mean, it's interesting. Silver in the past has always been roughly twice as volatile as gold.
Yeah.
So we hang on to that sort of idea as silver bulls that gold if gold breaks through this 2,800 level, let's say, then I think silver will be shooting off, because I think there comes a point where people look at it and they say gold's gone up, it's now going into new high ground, silver's been left behind, we got to buy silver. Yeah. So I think at that stage it rockets. It could be starting to rocket now. I mean, basically, it's kept pace with gold last year. I mean, they were both up about 25, 26% or something like that. If I look at the gold silver ratio at the moment, it's just under 90. I mean, that's crazy, absolutely crazy. On the industrial side, I mean, it's not priced as money. This is what that ratio is telling us. If it was priced as money, it would be under 20. Not priced as money. It's essentially an industrial commodity with, if you like, money sentiment in it. But it's been in deficit, according to the Silver Institute, for the last 4 years. So this is a commodity which the whole commodity sort of whole commodity complex begins to move higher on the back of gold. I think silver will be leading the charge.
Yeah, so what would be your message to the average man on the street? Buy gold, hold silver. What else? Is it smart to hold copper coins, platinum coins,
Well,
as a
I
physical
mean, as
gold?
money, no. I mean, my message is get the hell out of credit. So the man in the street then says, "How do I get out of credit?"
Yeah, exactly.
And I say, "Well, the answer is you got to get into real money, which is and has been ever since Roman times gold. That's real money." And don't think that the gold price is rising. It's not. It's your currency falling. So get out of credit. Your currency is the highest form of credit in your nation. Get out of credit. Get into real money. That's the thing to do.
Yeah, that's smart advice. Quick return to silver. Do you really believe that silver price is manipulated? And if yes, will we see an end to that thesis?
Well, um, I think the silver price has for a long time been controlled. And my suspicion is that it's been controlled by China, because for China it's a staple commodity, really, and even more so given the global move towards photovoltaic cells. And of course, India is now getting into the photovoltaic cell manufacturing industry as well. So they're becoming a demand source. And I think that control over the price is actually beginning to be lost by China because of India coming into it. Um, I discovered that this was the way it worked a long time ago, because I was speaking at a conference in New York, I think back in about 2010, something like that. And it was attended by a lot of silver mines. And these silver miners are obviously, basically trying to promote their share prices, looking for capital, whatever, whatever. And I asked all of them one question, and that is, when you've produced your silver, your silver doré, can you walk me through what happens. And they said, well, the first thing is the man from Glencore comes along and he evaluates, he gives a value to the to the doré. The doré is then shipped off for refining. We don't know where it goes. It doesn't interest us. The point is that we're paid by the bank introduced by Glencore, and the bank would probably be JP Morgan.
Yeah.
Yeah. JP Morgan basically was financing the mines with the collateral being the silver going to the refiner in China because refining silver is a dirty job. You know, no, none of us environmental people want to do this, so China does it. China keeps the silver or whatever, and they repay JP Morgan. But in terms of managing the price, JP Morgan, I think, is in league with China in the management of the price on the futures exchange and also in London. So you can see it's a triangle.
Yeah.
It's a triangle. As far as the mine is concerned, they need upfront payment because they have got costs. They've got to pay their workers and their, the diesel for the for all the equipment and all this sort of stuff. So there's that. That they get up front, and JP Morgan basically gets the business. Glencore also gets obviously fees out of this, and China does the refining. And guess who's got control over the silver? China. Yep.
Yeah.
So that's it, and it's the function of JP Morgan, if you like, to help manage the price, because the last thing China wants is to see the price rise. So they will feed in, whatever is necessary to keep the price down. I suspect that the Silver Institute's numbers are a bit suspect. I mean, it's very difficult for them to get accurate statistics, let's face it. But I don't think that changes the underlying situation that there has been, if you like, a lack of production and a lack of scrap compared with increasing demand. And that's certainly been the case for several years.
Sure, that's a brilliant overview of silver, and I agree 100% on all you said over here. Alasdair, I would like to hear your opinion, or maybe if you can tell me on what other commodities are you bullish at this moment? Okay, gold, silver. Do you like copper, uranium, oil?
Yeah, I mean, I don't actually, I'm not in the investment business anymore, so I don't sort of follow this. I mean, basically, my approach to the whole situation is economics, money, credit, geopolitics, and also domestic politics insofar as it affects economic outcomes. So I don't actually look at commodities as such. But as a broad brush statement, if gold is rising, given that over a long period of time, gold is stable, I mean, the purchasing power of gold measured in commodities can double or halve. But that's a lot less volatile than what we see with currencies. I mean, for example, a barrel of oil in 1950 was something like $2.53 or 56 or something. And that was when there were $35 to an ounce of gold. Since then, particularly after 1974, when the dollar's purchasing power started declining, the price of oil has been incredibly volatile and gone far higher. And that same barrel today, having been up to 140 at one stage, $140, is now roughly $77. So you can see that the volatility is actually all in the currency.
Yeah.
I reckon the value of oil measured in gold is roughly the value of oil measured in gold, I think is around about 60% of what it was back in 1950. So if you like gold, you can say that gold has gone up relative to oil, or oil has gone down relative to, That's so, the relative volatility is very, very small. It really is. So I think that I think that the future outlook for commodities is going to be very much dependent on the loss of purchasing power of currencies. And of course, this is no analyst in the industry looks at it this way because they all account in dollars or euros or whatever it is. So what they're looking at they're looking at commodity supply and demand in the context of we're accounting in dollars. So if they make a dollar price forecast, they see, well, you got this supply, this demand is likely to drive prices up, but they never ever think that the variation in price is mainly coming from the currency side. And this is the point they really miss.
Yeah. Alistair, how can investors reach out to you?
Well, I since I resigned from Go Money, yeah, where as we were talking off camera.
Yeah.
I mean, basically, I still write a weekly report for Go Money, but their customers are all pretty much converted, if you like. They understand that they must hold gold or silver or whatever. Um, uh, I think that things are getting now so dangerous that I needed to have a wider audience. So I set up my own Substack. And I'm very disappointed, actually, that Europeans have not really understood this at all. I think that's an audience which really would benefit, I think, by subscribing to my Substack. You can subscribe free, and I release quite a lot of content to free subscribers. But if you really want the analysis, then become a paid subscriber. If you find it by going either Macleod Substack, Macleod Finance rather, just Google that, or the proper address is alasdairmacleod.substack.com. The spelling of my name might be a little bit difficult for for anyone who is not from the Western Isles of Scotland, but so if you just go Macleod Finance Substack, it'll take you there.
We will make it easy for the investors. I will leave the link in the description of the video. That was
Please
Alistair.
do.
Yeah,
Please
that
do.
was Alistair Macleod. Alistair, I really appreciate your taking the time to come in my show. It was a great chat, as I expected, and I look forward to host you again.
I look forward to it. Thank you for asking me, Lucian.